Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster. Welcome to the Northbound Wealth Podcast, Weekly Market Insights. It's February 9th, 2026. I hope you guys are doing well on this Monday, and it is cold out there. And it looks like we're going to be warming up a little bit, which is fantastic. It couldn't come soon enough. Stocks were mixed last week with broad gains on Monday and Friday, bookending midweek selling pressure as investors digested earnings results from more than 100 S&P 500 companies. The S&P 500 index ended the weeks roughly where it started, slipping 0.10%. This week, as declines led by the consumer discretionary sector slightly outweighed gains, guided by consumer staples amid mixed earnings reports. The S&P 500 ended the week at 6,932.30 and is up 1.3% for the year. The NASDAQ Composite Index declined 1.84%. The Dow Jones Industrial Average rose 2.50%, closing above 50,000 for the first time as investors appeared to, quote, buy the dip, end quote. By contrast, the MSCI EAFE Index, which tracks developed overseas stock markets, rose 0.49% with dollar weakness as a tailwind. So, the headline: increased NASDAQ Tower Tech volatility and the Dow hits 50,000. The NASDAQ Composite experienced a volatile downward trending week ending February 7, 2026, marking its lowest 2 weeks stretch since the pandemic, with software stocks diving nearly 20%. Man, that area has just been absolutely obliterated. Baby out with the bathwater for the most part. Any good companies within that are just getting hit just regardless. But the index fell to a 2.5-month low, pressured by AI-driven selling and persistent inflation concerns before a Friday rebound partially eased some downside risks. Concerns over AI-driven disruption to legacy software business models triggered significant selling, with the iShares Expanded Tech Software Sector ETF experiencing its most oversold state since 2001. That's 25 years ago. Despite initial weakness, software stocks fell sharply, while large-cap tech saw mixed results following earnings reports from companies like Alphabet, or Google for that matter. The NASDAQ 100 hit a potential double top, with technical indicators showing a loss of momentum. Though a Friday rebound suggested some relief, the risk-off environment was driven by fears that AI could move faster than companies can adapt, combined with Fed messaging that rate cuts may stay on hold. While Friday's rally provided some stability, the index remained under pressure, with analysts looking for a break above the 26,150 level or the 26,200 level resistance area to confirm a return to the upside. Otherwise, a test of the 200-day moving average near 23,700 was considered possible. And turning our attention to the S&P again, for the S&P 500. The slim weekly move came as investors sifted through a mixed bag again of quarterly earnings reports and guidance. Companies including Hershey, PepsiCo reported quarterly results above analyst expectations, while others, including online retail giant Amazon, delivered some disappointments. On the economic front, ADP employment in the U.S. private sector increased less than projected in January. Investors continue to await government data on January's jobs after the Bureau of Labor Statistics pushed back its monthly payrolls report to February 11th. U.S. consumer sentiment reached its highest reading since August, but remained low compared with a year ago levels amid persistent concerns related to inflation and the labor market. Preliminary results from a University of Michigan survey showed. The consumer discretionary sector had the largest percentage drop this week, falling 4.6%, followed by a 4.4% decline in communication services and a 1.4% loss in technology. Amazon had the largest percentage drop in the consumer discretionary space, falling 12% on the week as the company posted Q4 earnings per share below analysts' mean estimates. Amazon forecast operating income of $16.5 billion to $21.5 billion for the ongoing quarter. This was below initial expectations by about $3.5 billion at the midpoint, according to Wedbush Securities analysts. Take-Two Interactive was among the top decliners in communication services. The company reported a fiscal Q3 loss of 50 cents per diluted share, wider than the loss of 39 cents per share expected by on average by analysts polled by FactSet, fell share 11%. Leading the technology sector decliners, Gartner and shares fell 25% as the company issued 2026 guidance below analysts' estimates. On the upside, consumer staples climbed 6%, followed by a 4.7% increase in industrials and a 4.3% rise in energy. Also, materials added 3.5%, while healthcare, financials, and real estate also rose by more than 1% each. Utilities edged higher as well. Hershey led the gainers in consumer staples with a 19% jump as the candy company reported Q4 adjusted earnings per share and sales above analyst expectations and forecasts 2026 adjusted EPS above the street's view. PepsiCo was also a top gainer in consumer staples, climbing 11% as the beverage and snacks company posted fiscal fourth quarter core earnings per share and net revenue above analyst expectations. PepsiCo also announced a 4% increase in its annualized dividend. The industrial sector's gainers were led by shares of Old Dominion Freight Line, which rose 17%. The company posted fourth quarter earnings per share above analyst mean estimates as revenue came in also above the street's view. Next week's earnings schedule features companies like Coca-Cola, Cisco Systems, McDonald's, T-Mobile, Applied Materials, Arista Networks, among other companies. The focal point of the economic calendar will be January jobs report on Wednesday, so we're going to be looking at that. The economic data due next week will include the January Consumer Price Index, a key inflation measure, on Friday, so we'll be following that. So performance review, year-to-date, MSCI EFA, which is foreign companies and indexes, 4.76% to the upside this year. Dow Jones is up 1.84%, S&P is down 0.60% for the year, Nasdaq's down 3% for the year. 10-year Treasury notes trading at 4.22%, and that is up from a month ago of 4.18%, but still kind of hanging in there right around that 4.2 handle. All right. FedWatch jobs data, the brief government shutdown that ended last week delayed several economic reports. The federal employment report for January, originally out on February 6th, delayed until Wednesday, February 11th. But payroll processor ADP reported on Wednesday that private employers added 22,000 jobs in January, about half of the 45,000 expected. Then on Thursday, outplacement firm Challenger, Gray, and Christmas reported that companies cut more than 108,000 jobs in January, the highest number of layoffs of any January since 2009. Investors tried to reconcile the reports with the Fed's January post-meeting statement, which read, quote, "Available indicators suggest that economic activity have been expanding at a solid pace. Job gains have remained low and the unemployment rate has shown some signs of stabilization. Inflation remains somewhat elevated," end quote. That was the Fed statement. Okay, interesting. Tax tip of the week, taking a side gig, taking one, doing the side gig, side hustle, here's how it may affect your taxes. Taxpayers who work in the gig economy may benefit from having a better understanding of how their work affects their taxes. People involved in the gig economy earn income as freelancers, independent workers, or employees. They use technology to provide goods or services, including renting out a home or spare bedroom and giving car rides. Here are some things taxpayers should know about the gig economy and taxes. Money earned through this work may be taxable. There are tax implications for both the company providing the platform and the individual performing the services. This income may be taxable even if the individual taxpayer doesn't receive a Form 1099-MISC, which is miscellaneous, Form 1099-K, or Form W-2. This income may also be taxable if the activity is only part-time, side work, or if you're paid in cash. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. And by the way, the OBBBA has no tax on tips, so you got to kind of stay up on the tax code or talk to a certified tax professional. All right, so on to the next segment. Oh, it is tax time, and we're getting down into the heart of tax season. If you receive income from investments, dividends, education savings plans, or contract work, you're undoubtedly familiar with the IRS Form 1099. So by the time April 15th rolls around, you might have collected a hefty stack. However, what might be less clear is when you should expect to receive them. Some insist that the deadline is January 31st, or maybe it's February 28th. For a small fine, the sender might have until late March 31st for certain Form 1099s. Regardless of the specific filing deadline, it is crucial to understand that you're responsible for reporting all taxable income, even if you haven't received a corresponding 1099 form. The IRS expects you to track and report all income accurately, so don't rely solely on these forms arriving in the mail. If a 1099 is missing by early February or mid-February or by the end of February, contact the payer to request a copy or use your own records to report the income when filing your tax return. So here are some common Form 1099s. There's the Form 1099B. That's the sale of stocks, commodities, or other securities. There's the Form 1099 DIV or DIV, which is income from dividends and distributions. 1099 INT or interest, which represents a filing for your interest payments. Form 1099G, which is payment from federal, state, or local government, including local tax refunds or unemployment benefits. There's the Form 1099 miscellaneous or MISC, which is miscellaneous income from, say, side hustle, gig jobs, whatever. Form 1099 NEC, which is the non-employee compensation 1099. Make sure you grab that. Form 1099Q, payments from 529 plans or other qualified education programs. So if you got kids and you have those 529s and you're making distributions to pay for education and things like that, make sure you grab that one. Form 1099R, distributions from pensions, annuities, retirement accounts, or IRAs. Form 1099S, income from real estate transactions. So maybe your settlement statements, things like that. Form 1099SA, and those are for distributions from health savings accounts or Medicare Advantage medical savings accounts. The source of that information is irs.gov, but businesses, financial institutions, and even local governments have any number of reasons for why they might not send Form 1099s as early as you expect to receive them. Some are still balancing their books until the last minute, and certain investment funds may take longer to reconcile overseas holdings. Whatever the reason, this can cause a fair bit of consternation as you might feel pinched between waiting for the mail and looming tax deadlines. Here are a few things you can do while you wait. Number one, make a list of the forms 1099 you expect to receive. So having a checklist and trying to look at all your accounts, make sure you have them all. Proactively tracking expected Form 1099s may help you avoid surprises or, worse yet, neglecting to file one with your taxes. Number two, check the online portal if available. In most cases, a digital copy of the expected Form 1099 may be available up to a week before you receive it in the mailbox, because things do get lost in the mail. Better look online, right? Number three, watch out for corrected 1099s. That's one that gets people sometimes. The Form 1099 you receive may be an estimate instead of the final version. So read any accompanying material and check for a watermark. Okay, so maybe you might get their first iteration early February, mid-February, and then a new one comes out later. So you got to kind of double check that before you file. Keep your address current. That's number four. The IRS will get a copy whether or not you get yours. So make sure you give the sender the right information to send your Form 1099 to correct the address. Number five, look for errors and report them ASAP. You may not have much time to correct any errors, so be sure to open, read, and act on your Form 1099s as soon as you receive them. Six, the IRS gets a copy too, so don't forget the IRS receives all the copies. So, make sure you're paying attention to that. And number 7, be cautious with draft 1099s. Some financial institutions may send preliminary versions of Form 1099 labeled as a draft. These are not final and should not be used for tax filing. Be sure to wait for the official version, which will be marked as final, to avoid errors or amendments to your tax return, which can be costly. Check your accompanying materials for clarification. And then when to get help. Don't go it alone. Please reach out if you're unclear on which Form 1099s you might receive, why, or even when. As financial professionals, we may be able to help you understand what you might expect and how it impacts your overall financial wellness. And remember that this notice is for informational purposes only and is not a replacement for real life advice. Please consult your tax, legal, and accounting professionals before modifying your tax strategy, and let us know if you'd like to set aside some time to chat here at Northbound Wealth Management. All right, thanks for tuning in. Stay tuned for the next segment. I was reading an article by one of my favorite chief global strategists, and he's at JP Morgan Asset Management. His name's Dr. David Kelly. And if you want to follow and subscribe to his stuff, I'd highly recommend it. It makes you think a little bit, and been following him for a long, long time since I worked at JP Morgan back in 2009. Subscribe to the notes on the week ahead. That's his newsletter to receive it directly in your inbox. And you can listen to his podcast on Apple and Spotify. But I just want to pull out an excerpt from his latest post. It was out there on LinkedIn. I saw his notes from the week ahead. That's this week, February 9th, starting today. There was a section in there that I thought was pretty interesting, which I want to share. He addresses the demographic drags and inequality implications in our economy. I hope you guys enjoy this. I thought it was interesting. It makes us think a little bit about how things are going in this particular subject. Okay. So in short, he says, there are two major issues. The working age population is shrinking, and I think he's referencing the boomers there, and the median American family is not doing nearly as well as the richest. I think that's to address the K-shaped economy. On the first problem, the Census Bureau released new estimates last month documenting a slowdown in immigration. Particularly, I have an opinion about that. I think that's actually a good thing because our country, despite what happened during the Biden administration, our country is very favorable to people coming here. We legally allow about 300,000 people to come here to the United States every year, which is more than almost any other country. I think it is the most, actually. Specifically, Dr. David Kelly goes on, he says, specifically, they estimate that in the year ended July 1st, 2025, net immigration was 1.262 million, and the total population grew by 1.781 million, or 0.5%, down from net immigration of 2.734 million and a total population growth of 3.249 million, or a 1% a year earlier. However, crucially, they noted that net immigration fell sharply over the course of the last year, so that when projecting out to the year ended July 1st, 2026, they expect net immigration of only 321,000, leading a total population gain of just 835,000, or 0.2%. While they have only published these top line numbers for the current year, these estimates are very close to the assumptions they used in their low immigration scenario published in November 2023. In that forecast, they assume net immigration of 389,000 in the year ending this July, and they outlined what that would mean for a population growth at every age level. Making some minor adjustments to line these numbers up with their current forecast suggests that if their projections from 2 weeks ago are correct, the population aged 18 to 64 is now falling by 20,000 every month. This has important implications for consumer spending, housing, inflation, and the labor market. On the consumer side, it suggests diminished demand for consumer staples and relatively stagnant demand for housing. This is likely one of the reasons for a gradual increase in rental vacancy rate, which, according to the Census Bureau, rose to 7.2% in the fourth quarter of last year, the highest level since 2017. This will impede any robust recovery in home building. However, it should also help to reduce inflation. The same census survey that showed rising vacancies reported rents on vacant units falling to their lowest level in over 2 years. This softness in rents, if it persists, will have a major impact on reducing inflation going forward, given the importance of rent and owner's equivalent rent in the CPI, or the Consumer Price Index. Interesting how rents are dropping as immigration and illegals are leaving. We still think that year-over-year CPI inflation will rise above 3% by the middle of next year, but it could fall to close to 2% by the end of 2026, given this weakness in rents. On the labor market, a steady decline in the working age population is slowing the growth in employment. In a close to full employment economy, you can't add many jobs while shrinking the number of available workers. However, it will also limit any increase in the unemployment rate. The labor market today isn't strong, but it is tight, and the unemployment rate could well end 2026 below its current 4.4%. The other issue impacting consumer spending is the concentration in gains in income and wealth. Unfortunately, we don't have real-time data on income inequality. The latest numbers are from 2024. However, they show a continuation of a long trend of rising inequality dating back to the mid-1990s. One way of thinking about this is to look at the difference between the average American household and the median American household. Statistically, the average is found by summing up the total income and dividing by the number of households. The median simply refers to the experience of the household at the 50 percentile, okay? If income was evenly distributed or even symmetrically distributed across society, then median income would be equal to average income. However, in a society where a few households are doing very well and the vast majority have much more modest incomes, the median is below the average. In 2024, the median pre-tax income of American households, excluding capital gains and non-cash benefits such as health benefits, was $83,700, while average income was 45% higher at $121,000. This gap, in percentage terms, has been rising steadily for many decades. In 1967, for example, average income was only 12% higher than median income. One result of this is that, while in real terms, average household income increased by 0.9% per year in the first 25 years of this century, median household income increased just by 0.6%. There are, of course, many causes for this rising inequality. A booming stock market and rising property prices have helped richer households, as has more favorable tax treatment. Increasing numbers of college graduates has coincided with K-12 problems across the country, leading to a rising wage gap between those who have been able to take advantage of educational opportunities and those who have not. And increased automation and foreign competition have severely reduced manufacturing as a pathway to a comfortable income, which is why I think there's a focus on bringing manufacturing back to the United States to try to increase wealth of the lower half of the economy. That's my opinion and observation of what he's saying. As in the case of weaker demographics, while rising inequality is not currently hurting the stock market or tech spending, it is dampening the demand for basic goods and services and housing. Moreover, one result of rising inequality is that most Americans feel that the economy is not working for them. This shows up in consumer confidence surveys, and it does. I'll attest to that. You can see it. However, Dr. Kelly goes on, it also shows up at the ballot box in 2024 and is generally agreed to be the single biggest reason for the election of the current administration. It could also show up in this November's midterm elections. On average, over the past 10 midterm elections, the party occupying the White House has lost an average of 22 seats in the House of Representatives. With the current House majority standing at 5 seats, the odds favor a return to Democratic control in the next Congress. If this occurs, then the administration may find it very difficult to push through further stimulus before the 2028 presidential election. In this scenario, even if the tech capital spending boom continues, the economy is likely to settle back to a path defined by its demographic and income inequality challenges. This is a path of slow GDP growth, low unemployment, and falling inflation. This raises the possibility of some further Fed easing in 2027, helping the bond market. However, it also increases the importance of diversification, particularly if these real economy challenges are amplified by any faltering in the artificial intelligence boom. Wow, there's a lot to unpack there. He's a good one to follow to stay up on some of the stuff that JP Morgan Asset Management is communicating out and they're analyzing. And again, Dr. David Kelly is a champ. He's awesome. I like to follow, listen to what he has to say. Chief Global Strategist at JP Morgan Asset Management. And you can subscribe to Notes on the Week Ahead, his newsletter, and receive it directly in your inbox if you'd like. But that excerpt I thought was very informative and how we can look at different challenges the economy is facing. All right, stay tuned for the next segment. Hello, everybody. I'm going to talk about Palantir Technologies. They engage in the business of building and deploying software platforms that serve as the central operating system for its customers. It operates through commercial and government segments. The commercial segment focuses on customers working in non-government industries. The government segment is involved in providing services to customers that are the United States government and non-United States government agencies. Its platforms are widely used in areas such as defense, intelligence, healthcare, energy, and financial services, supporting data integration, large-scale analytics, and operational decision-making. The company was founded by Alexander Kriedman Karp, Peter Andres Thiel, Stephen Cohen, Joseph Longsdale, and Nathan Dale Gettings in 2003 and is headquartered in Denver, Colorado. They had their last earnings release February 2nd, which is why I'm going to looks like the market's open today on Monday. And today actually is February 9th. Thanks for tuning in to the Northbound Wealth Podcast. All right. So again, Palantir, let's take a look at where the stock is trading. Looks like trading around 135 a share. Its all-time high was 207. So $207.52, and that was achieved basically November 3rd, 2025. 52-week low is $66.12, so it's trading right in the middle of the high and the low. Year-to-date total returns down 23.54%, and there are 27 analysts covering the stock. The consensus recommendation is an outperform rating on it. You can have a buy, hold, underperform, outperform, or sell. And so there's 10 buy recommendations of the 27. One outperform, hold is 13, underperform is 1, and sell is a 2. Overall, again, analyst recommendations are an outperform in the price target of consensus would be the high is $260 a share in the next 12 months. The low is looking to be 66.12, or a low recommendation of $70 per share. It's currently trading at $135.90, and the median price would be $190.75, which represents a 40.3% upside to the price target. So if you believe in the thesis that it's going to actually hit that price target of $190.75 or even higher, looks like you've got quite a bit of an upside ahead of you, which is substantial. I do like the stock, and we here own it at Northbound Wealth Management. Believe that it is a key disruptor in the AI space, and I think it's going to be a good one over the long run. They have a 5-year revenue growth rate of 32.58%. Revenue quarter over quarter, year over year growth is 70%. Think about that for a second. See, they've got, revenue coming in at $4.475 billion, net income $1.635 billion, EBIT and of $1.414 billion, EBITDA of $1.44 billion, revenue. They are growing at a clip that we haven't seen most companies grow at. Cash flow from operations $2.134 billion. Looks like their free cash flow of $2.101 billion. Operating margin is 31.6, gross profit margin 82.37. Return on invested capital is around 25.54, return on equity 26.52, return on assets 21.82%. And debt, long-term debt, total liabilities quarterly $1.412 billion. Long-term debt would be $183.47 million. So they're not like super heavy on the debt load. And so that's pretty exciting for a company like this. They've got a revenue per employee of $1.137 million. Net income per employee is crazy, $415,305. They've got really good momentum. There's a lot of good data across the board. So I still believe in the stock. I believe in the company and what they're doing and why. I think that it'll be part of our portfolios for some time, and unless it changes course, and we'll change course if it changes course. There were quite a few tech names being thrown into the software bucket and people selling software because AI is disrupting software. So I'm going to continue to track Palantir stock as we move forward. But it looks good. It looks like good, maybe potential buying opportunity for folks that maybe don't own it. All right, let's look at Alphabet. They reported last week. They have a market cap of $3.909 trillion. That's trillion. 52-week high, $350 a share. 52-week low, $142. All-time high on the daily chart was $350.15. So $350.15. Year to date, it's only up 2.96, but still, that's good on a tape that's been read. They've been holding in there pretty well. The last 12 months return 67.8%. So it's really positioned itself as an AI leader and a key player in the space, as well as the tech space, obviously. 5-year revenue growth of 17.18%. Revenue quarterly year-over-year growth is 18.19. EPS diluted 5 years growth is 29.82. And we've got return on equity of 36.01, return on assets 25.82, and PE ratio of 29.90, whereas the PE ratio for Palantir was way higher, paying up for that growth. But 29.90 isn't super cheap either, obviously, but it's not like out in crazy land either. A high price target of $400 a share, currently trading at $323.10. So it's down from the high of $350.15. Got around 68 analysts following the stock with a consensus rating of a buy. 48 of those are buys, 12 are outperform, 8 are hold. There are no underperforms or no sells. So that tells you a lot about sentiment, where people think the stock's going to go, and probably up and to the right is what a lot of the analyst community believes. And for those that don't know what Alphabet is, it's a holding company which engages in software, healthcare, transportation, and other technologies. It operates through the following segments: Google Services, Google Cloud, and other bets. The Google Services segment includes products and services such as ads, Android, Chrome, devices, Google Maps, Google Play, Search, and YouTube. The Google Cloud segment refers to infrastructure and platform services, collaboration tools, and other services for enterprise customers. The other bet segments relates to the sale of healthcare-related services and internet services. The company was founded by Lawrence Page and Sergey Mikhailov Brin on October 2nd, 2015, and is headquartered in Mountain View, California. They're in the communications sector or services sector. Industry is interactive media and services, and their next earnings release would be in April 23rd, that is. The last one was on February 4th, and they do pay a very small dividend, so you can look up when those dividend payments are, but it's a small one. overall, the fundamentals are 9 out of a 10. They are killing it. They are doing a great job. And some key highlights in that is cash from operations. This is insane. So $164.71 billion cash from operations. And their free cash flow right now is $73.27 billion in free cash flow. And they're sitting on ending cash for the quarter, this past quarter, of $38.29 billion after their CapEx expenditure was $91.45 billion. So even after that, they're still sitting on $38.29 billion in cash with free cash flows happening like crazy. They've got operating margins of 32.94%, gross profit margin of 59.68%, so nearly a 60% margin. Which is why revenue, just look at this revenue, $403 billion, net income of $132.17 billion, EBITDA $153.9 billion, quarterly revenue of $114 billion. So think about that for a second. Their quarterly revenue is $114 billion. Revenue is, it's just insane, guys. Liabilities, long-term debt of about $63.79 billion. They have total assets of $595.28 billion and liabilities of $180.02 billion. Return on equity of 36.01%. Return on assets is 25.82%. Return on invested capital is 32.36%. So I don't think Google or Alphabet is going anywhere anytime soon, and it remains to be a good long-term investment, especially based on the stock performance. All right, let's dive into Eli Lilly. Eli Lilly this morning is trading at $1,058.18 a share. They reported earnings last week as well, and they're based out of Indiana, right here in the Hoosier State. This is where we're domiciled and located. Eli Lilly engages in the discovery, development, manufacture, and sale of pharmaceutical products. The firm's products consist of diabetes, oncology, immunology, neuroscience, and other products and therapies. The company was founded by Eli Lilly in May of 1876 and is headquartered in Indianapolis, Indiana. All right. They're in the healthcare sector, pharmaceutical space. Their next earnings release is April 30th. Last one was on February 4th, so it just happened. They have a dividend. It's a small one, but they're at a market cap, get this, of $947 billion. They're almost $1 trillion market cap. When in recent history, prior to 2020, they were nowhere near that. It's crazy. Eli Lilly's stock price at the end of 2020 was like $116 a share. Now it's $1,058. Just think about that for a second. 52-week high, $1,133.95. The 52-week low was $623.78. Well, that would have been a good buying opportunity, huh? All-time high, again, 1133.95. Year to date, it's down about 1.54%, but it's holding in there well given the redness of the market recently. Revenue 5-year growth is 21.58%. Looks like revenue quarterly year-over-year growth 42.56%. Looks like they're doing quite well on their performance here in drugs and therapies and getting new releases and FDA approvals and then being able to distribute that throughout the world. Analyst coverage, here's the price 52-week range and the price targets. Looks like the high price target is $1,500. The low is $830. We're trading at $1,058. So kind of on the upper end of that range, which makes sense. And then also the consensus is price target right around 1,191. So a little bit higher than where it's currently trading now. You got 29 analysts. Consensus rating is outperform. That doesn't surprise anybody. The buys are 17, outperform are 4, holds are 7, underperform is 1. Price target standard, let's see here. Price target upside is 11.82% to the upside from where it's trading now to a consensus kind of midline as far as price targets are concerned. Okay, we're going to look at some key statistics and kind of go over that. Revenue, $65.18 billion. Net income, $20.64. EBIT is actually EBIT on these guys on what they report, 29.69 billion. The quarterly revenue is 19.29 billion, net income 6.636 billion, and just cranking away. We've got return on assets of 21.5%, return on equity 106.3%, and then return on invested capital 36.38%. Operating margins of 45.56%, gross profit margin 83.23%. So they are cranking and crushing it for a pharmaceutical company, growth year one. It's pretty cool to see a Hoosier State company do well. Let's see here. If you haven't been paying attention, I mean, about $6 billion in free cash flow per quarter. Debt to equity ratio is 1.786, and their current ratio is 1.546. So like Lilly, obviously want to look for opportunities to add to the portfolio and not at crazy valuations. So this one has been tough to get into just because it has done so well and moved so fast over the years here. All right, Amazon reported last week. Let's take a look at it. Amazon, for those that don't know, is a multinational technology company which engages in the provision of online retail shopping services. It operates through the following segments: North America, International, and Amazon Web Services, or AWS. The North America segment offers retail sale of consumer products, including from sellers, advertising, and subscription services through North America-focused online and physical stores. The International segment focuses on retail sale of consumer products, including from sellers, advertising, and subscription services through internationally focused online stores. The AWS segment is composed of global sales of compute, storage, database, and other services for startups, enterprises, government agencies, and academic institutions. The company was founded by Jeffrey Bezos in 1994 and is headquartered in Seattle, Washington. They're part of the consumer discretionary sector. Industry is broadline retail. Next earnings release is going to be April 30th. This last one was on February 5th. And we've got, 68 analysts following the stock. 48 say buy, 16 say outperform, 4 say hold. And then you've got a high price target of $360, a low of $175, and we're trading right around 210. Their midline is around 283 as far as what the average price target would be. The target to the upside is about 40%. So it's already a pretty big position in the book for Northbound Wealth clients, it seems. And I'm going to be watching the stock from this level of the 200s to 210 and see if that holds and then builds up a base, as Amazon's going to continue to do really, really well with AI and the adoption within, I think, the consumer segment. I mean, who doesn't use Amazon? It'll be interesting to see how they do this year. But yeah, there was a sell-off, might present an opportunity for those that don't have Amazon, but not advice, not a recommendation to buy or sell, but just think about it. Let's take a look at some key statistics. Their market cap right now is $2.258 trillion. So they're in the trillionaire club, and the all-time high, as a reminder, was 258.60. Year to date, it's down about 8.88%. In the last 1 year, it's down about 12%, a little over. But check this out. 5-year revenue growth, 13.18%. Revenue quarter year over year growth is 13.63%. EPS, 27.96% on a 5-year growth. Return on equity is about 22.76. Return on assets, 11.11. And I think the key statistics are good. Let's look at this here. Yeah, revenue off the income statement is $716.92 billion. Think about that. It's huge. Net income, $77.67 billion. EBITDA, $150.37 billion. Okay. Quarterly revenue is about $213.39 billion per quarter in rev. Net income, $21.19 billion. And it's just crazy. We've got return on assets of 11.11 again, return on equity 22.76, and return on invested capital 15.66%, operating margins of 11.8%, gross profit margin 50.29%. So a little more labor intensive. They've got higher liabilities. So their total assets are $818 billion, total liabilities $406 billion. So a little more debt to Amazon, but boy, a lot of people use the AWS platform and they also use their services a lot. So like Amazon Prime and the rest of it, I mean, they're getting into all these different segments. It's becoming diversified businesses in and of themselves. And that goes for Google as well as Amazon. P ratio is 28.61, so slightly below where Google is trading at. Amazon has 2 million employees, by the way. Revenue per employee is around $457,805.90. Net income per employee is around $49,597.70. Pretty crazy. And then they're going to lay off 16,000 seasonal workers. So they're going to save some money. That number should go up on that. And then they turn around and hire a bunch of seasonal workers back before the season actually gets going. Okay, we'll see how this the spend in AI will impact them, but free cash flow, I guess, still pretty good. $7.695 billion in free cash flow, ending cash quarterly. They had $109.88 billion in cash, and their cash flow from operations is $139.51 billion. So they're in good shape, pretty much, and remains a pretty core holding in the portfolios. All right, I think I'm good with covering Palantir, Google, Eli Lilly, and Amazon. I was going to go over Uber and Walt Disney. Maybe I do that later. Thanks for tuning in.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.